morning, and thanks for tuning in to this special broadcast on BloombergQuint. I'm Alex Matthew. Now, there's no doubt that we're living in unprecedented times, mostly on account of the COVID-19 pandemic. Now, yesterday there was some not so good news in the mutual fund space. Franklin Templeton announced that it was winding down 6 of its actively managed credit funds or fixed income funds. Now, market veterans are saying that this is going to come as a body blow to the industry, but on this program, we're more concerned about what it means for you, that is, the retail investor. So, if you had investments in any of these funds, what does this announcement mean for those investments? Why did this come to pass? And what are the likely repercussions across the industry and specifically in the fixed income space? We're going to try and answer all of those questions. And in fact, of course, if you're logging in live to this broadcast, then your questions are more than welcome. We'll try and take as many as possible over the course of the next 15 minutes. But joining me to make sense of all of this, I have two financial experts, both of them certified financial planners, Suresh Sadagopan and Arvind Rao. Thank you so much to the both of you for joining me on this conversation. I do want to take both, in fact, my guests today as well as all of you through the first bit of the conference call that I managed to listen to. Of course, there were a lot of participants on that call, so a lot of people didn't manage to get in. But essentially what they have said is that, and I'm reading out the notes that I've gotten on this, COVID-19 has resulted in significantly lower liquidity in the bond market for securities. This is what the management of Franklin Templeton has said. There was also huge redemption pressure. They were initially able to meet that redemption pressure, but soon it was no longer possible for them to generate the kind of liquidity that was required to meet that daily redemption that was coming in. They did resort to borrowing within permissible limits initially, but given that the timeline of the pandemic was unclear, especially because the lockdown was extended once, it was not prudent, according to them, to leverage their other schemes further. Now, they explored other possibilities, but they felt that this was the best way to protect the value of the unit holders. We'll get into that and how they're trying to do this. They're saying, what does this mean? No further transactions will be processed, is what they're saying. Redemptions, STPs, SIPs, SWPs, all of them have stopped as of now. So let's get to the crux of the matter. And Suresh, I want to talk to you first about this. This is unprecedented. What does this mean for the investor in any one of these 6 funds that have been shut down?
Yeah. So depending on the duration, the tenure of the papers, so what the strategy that they are intending to adopt is that they are going to stay invested, and as and when the accruals come, they are going to distribute. That is what they have kind of indicated. Okay, if that is what they are going to do, probably people are going to receive in the low duration much earlier as compared to, for example, income opportunities or short-term income funds. So as and when the accruals come, they will be taking that in and they'll be distributing to the investors. So that is what they are saying. So probably there is going to be a wait time as far as investors are concerned before they see their money back. The only other thing which I can think of is that if this COVID crisis, as and when it gets resolved, and suppose the debt markets, come back into their own, into their normal position, then there is a possibility that they may be able to sell some of these even before maturity in the secondary market. But when that will happen and whether that will happen. So the best possible scenario is we have to hope that these companies which they are holding, they are in a position to pay. They are not affected massively by COVID, and they are in a position to pay both the interest.
I want to actually go into the nature of these funds. We're, in fact, talking about 6 funds. In fact, let's pull up that graphic if we possibly can, just to display the names of these funds. And Arvind, they're not all credit risk funds. In fact, I think my viewers will be familiar with the nature of credit risk funds in that inherently they take on more risk. So let's actually break down this for the benefit of our viewers. From what I can understand, the low duration funds have a duration of between 6 to 12 months, Arvind. You have the short term income plan, which is 1 to 3 years. And you also have the ultra short term bond funds, which are 3 to 6 months, which was essentially what Suresh was talking about, which is the low duration funds. But these are not supposed to be funds that take on a large amount of risk, right?
That's right. But I guess here
To this
the
point.
conversation is probably not more about the risk now. Now, um, I mean, little glimpses on the call that went. What we could understand is that the last year or two, Fund House has seen redemptions to the tune of almost 25,000 crores. So, given the uncertainty about the present crisis, and if redemption pressure continues, obviously it was getting very difficult to make available this money to the investors. So, I think if you have to read into this decision now and make some optimistic or a positive sense out of this, what I think we should be looking at is key. They have just kind of put the fund or the money flow from the fund into a lockdown. So, like you mentioned some time back, that no new money can enter into the fund, and at the same time, money will not be able to flow out of the fund, whether by way of STP, SWP, or even redemptions for that matter, at will. Depending upon when the money matures or depending upon when the coupons come, the fund will be taking a call and making distributions on a periodic basis. Now, here is where the average maturity of papers held in these instruments that will come into play. So on the lower end, when you have these low duration and the ultra short bond funds, where the average maturity will be, as you mentioned some time back. So this is the kind of period that investors can now keep in mind, will be the window in which their monies will come back. And when they say, and when the fund meant monies, I think they have specified that it is going to be the capital plus the gains accrued on that.
Right. Understood. All right. So that's essentially what we can expect in terms of getting money back. But of course, there's the nature of the paper that they've invested in, and there's always the credit risk. Suresh, I want to at this point just try and make sense of the risk involved, not just in the funds that we've mentioned, but if you can break down the types of risk involved in fixed income as a whole, so that if my viewers are logging in and trying to decide on their portfolio side what they need to do when they're looking at it, how do they judge what kind of risk that they're exposed to right now?
Yeah, so when one is investing in debt mutual funds as a category, see, all the papers which are underlying in any scheme are all quoted in the secondary market. And because of that, the papers have a certain price every day, and it is marked up or marked down according to whatever is the value is there in the market. So the NAVs are set based on the prices at the end of the day. Okay. So there is going to be a certain level of volatility, so people will be aware about that. And this volatility will be a factor of the interest rate in the system. So RBI essentially controls the interest rate. So mutual fund schemes, all mutual fund debt schemes are subject to interest rate risk. Yes. Then there is the fund manager who is actually managing the portfolio. The fund manager obviously is a very is a specialist and who has the appropriate experience, qualifications, expertise to manage that. But still, they may be taking certain calls. They may be having certain strategies which may positively or negatively impact the scheme. So that is potentially the fund manager risk. I mean, the normal investor is going to a fund manager because they don't know too much about that particular segment, that is the debt segment, and that is why they are going to go to a specialist. But still, there is always a fund manager risk. So it is active management by the fund manager. It is not passive management. So there is a certain level of risk. then there is a credit risk in the sense if the paper is lower quality, which is the problem we are currently having. If the paper is lower quality like A or A plus or double A minus, that kind of paper, as opposed to a triple A, then inherently these papers may be paying a higher interest inherently, but they also carry a higher level of risk, and that is precisely why they are also paying a higher interest rate. So there is this credit risk also, which we will have to keep in mind. So if investors are interested in keeping their money safe, then they should be investing in higher, schemes which are investing in higher rated papers.
Right.
So these are some of the risks.
I'll get to the point of what one should do with future investments. But before that, I do want to talk about what one should do with current investments. So I'm sure that a lot of our viewers have investments in debt mutual fund schemes. And the worry really, Arvind, is that there could be a sort of a spread in this sort of panic that redemption pressure will push other mutual funds into a similar situation. Now, the industry body AMFI has stepped in to try and calm nerves somewhat, and it's essentially trying to tell investors to not treat this as an industry-wide phenomenon. It is a specific mutual fund or asset management company that's facing an issue. In fact, there's a statement that says that SEBI regulations, this is from AMFI, SEBI regulations allow mutual fund schemes to borrow up to 20% of their assets to meet liquidity needs for redemption or dividend payouts. And while AMFI is in the process of collecting the data, many mutual funds have informed them that they don't have any outstanding borrowing. Now, with Franklin Templeton, of course, Arvind, it was a situation where they had borrowed and they were close to that limit, and they decided that they couldn't take additional leverage to meet those redemption pressures. But the question really that I'm sure a lot of people are asking at this point is, are they at risk? The funds or the schemes that they're invested in, should they be concerned at this point? And it's a bit of a tricky question, because if they start thinking of redeeming, it'll put more pressure onto the system.
Absolutely right, Alex. And I think the questions, the way they are coming from investors, which I believe is absolutely in the right order. So first question in their minds is obviously what happens to our investments in these funds by Franklin where they have their money. And the typical answers will be these that we have been talking over the last 5 to 10 minutes is the one that are available, that the money is probably not impacted, subject to any default or credit risk, like Suresh explained about the various risks there. But the immediate next question that is following now is, what happens to my money in the debt fund with other agencies? So we understand that Franklin has taken a lead and has taken a bold step regarding the 6 of the debt funds. But what is unclear or unsure now is what happens to money in other debt funds. So, I believe this is pointing to a huge systemic error, because not an error, a systemic risk here, because most debt funds have their monies in debt instruments of other corporates. And along with the risks that Suresh pointed out in relation to debt funds, I think we are looking at a different kind of a risk now, which is the whole economy risk. The way this COVID-19 has impacted or is impacting the economy and the various industries as a whole, nobody is sure in terms of what kind of defaults one should expect or one can see in the coming months. So this risk is definitely percolating into the debt segment as well. And I would say this risk is equally applicable to banks as well as mutual funds, because while mutual funds have been investors in various debt papers, banks too have been lenders to a lot of companies and industries. And the risk of default due to this economic risk lies, I think, exposed on both fronts. So
yes,
I feel that the investors, instead of pressing the panic mode, have to take some time and kind of digest this, instead of uh,
All right.
into
I believe we're having a bit of an issue with Arvind's Skype line, but I think the point that he was trying to make just at the end, Suresh, was don't press the panic button. That's really hard to do. Hard not to do, in fact, because a lot of people will say, in fact, people are shouting from the rooftops right now that fixed deposits are the way to go in terms of debt investments, and they're much safer to invest in because despite the fact that you're getting a lower rate of return and the tax incidence in certain cases is higher, at least it's safer. Is that something that will now become the norm, Suresh?
So, I mean, to some extent, what you're saying is true, but I'll just go back to what Arvind was saying. See, if
Yes.
there is a problem in the economy as a whole, banks are not immune to that. Corporates can be affected, banks can be affected, and mutual funds which have invested in corporate affected. In fact, the entire debt markets can be affected if the economy is shut down for a long period of time, and that is the broader worry. The entire debt markets can be affected. So let us come to the other point as far as whether investors have to be really worried about all the debt funds. The short answer is no. Because see, as far as Franklin Templeton is concerned, they have a very clear articulated strategy, which is a credit risk strategy. They have done it very well for a long period of time. Now, at this point in time, due to huge amount of redemption pressure and the unprecedented crisis which they are upon, because of which there is a liquidity issue in the market, secondary market, especially for low quality papers, they have come upon this unprecedented situation. See, that is not true for all the mutual funds. In fact, if you look at many of the fund houses, they have a very, very clear strategy of only having very, very high quality papers. And I can quote several instances. So if that is the case, I would say mutual fund is much, much safer as compared to direct investment in any one corporate or even any one bank. I reiterate, even it is probably safer than investing in a bank because the underlying papers, there are a number of underlying papers. There are probably 20, 25 papers. So there is a diversification which is happening. So if there is a default in say 1, 2, 3, your entire capital is not going to go bust. So in that sense, actually mutual fund is a good investment. Yeah, one needs to keep track of that. And one needs to see whether one needs to move into higher quality papers or ones where there are lesser risk. Like for example, gilt funds. One could get into gilt funds. One could get into Bharat Bond FOF. Of course, one could get into bank deposits. One could look at banking and PSU debt funds. These are comparatively safer instruments. One can look at sovereign gold bonds if gold allocation has a place in their portfolio. RBI bonds are available at this point. There are multiple options. It's not that options are not there for the investors.
Fair enough. Suresh, I want to actually just come in here and obviously just as a mention, the RBI's LTRO, that's the targeted repo option, the operation that was meant to really help some of those small NBFCs didn't find a lot of takers. So it's very clear that there is a bit of a risk aversion even from the institutions that are buying these papers. But to that point, is it very clear about investments going forward now? You're pointing out that there's a lot of options out there, but when you're talking about specifically fixed income investments in mutual funds, you're looking at AAA securities, very high quality securities, and the shorter end of the spectrum?
Correct, absolutely. So normally the strategy that we generally have been adopting is high quality papers, shorter end of the spectrum, and ideally accrual strategy. So we are hoping that if we are having a high quality paper and if it is shorter duration and the strategy is accrual, the interest rate risk will not also affect them. So if it is say a 2-year paper or 1.5-year paper, at the end of it, I'm going to get the principal and definitely the interest in whatever duration, whatever time frames they were supposed to pay. So I would say broadly that will be a strategy as far as the overall debt market is concerned. And as far as questions are concerned, I would go for gilt securities and AAA rated PSU bonds. So those kind of underlying, if it is there in the mutual funds, I would go for that for the longer duration.
Okay. So there is one question that was actually mailed to us, and I think I'll take it to Arvind if we possibly can. We've got one. Well, he says that he's an ultra HNI, And he says that he's invested 20 crore in Franklin Templeton ultra short-term fund since 3 years. This is actually quite a popular scheme that was out there in the market, and he's been investing, he says, for the last 3 years. What should he do, and should he expect, of course, that his money will come back over that period of time?
Yes. So, I mean, again, some snippet from the call is that although they have not clearly defined, but what somewhere it got indicated is probably that they're looking at definite um, periodicity in which they will try to repay the money back. So, coming back to this question of what can be done by such an investor now, the answer is that see, obviously, no other redemptions is possible from the fund now. So
Yes.
there has been quite you can say a decent assurance or decent indication by the I think indication is the right word that has been given by the AMC that by stopping over the counter redemptions, what they're ultimately trying to do is protect the value that already exists in the fund so that the investors who have stayed back will get most of it back.
Okay. Okay. Now, Suresh, one question. This obviously is something that everybody is wondering, but perhaps you can, make a little bit more sense here. There's a question from Frankie Johnson. He's asking whether there's no buyer for AAA bonds too, and what does this winding down say? Is it a warning sign that the Indian economy is staring at a big crisis?
See, in a situation like this, you may see a lot of news swirling around. So the entire bond market is not shutting down. So I can tell you that in an economic crisis like this, it is quite normal that the lower rated papers may not find too many takers. It's but obvious. These AA or A plus or A minus, these kind of companies, they are having a particular rating because to start with, they were not really that very sound. Okay. And in a crisis situation, these are the people who are going to get affected the most. So, I mean, I would not really unnecessarily panic and say that everything down and even AAA rated papers, there are no takers. Actually, the fact is that that is not true. AAA rated papers are trading. The volumes I don't have at this point in time. Currently, as far as some of the papers of lower quality, there is a problem. The problem came to the fore in the case of Franklin Templeton because the quantum of lower quality papers in that portfolio is significant, say 35, 40%, 45% kind of thing. Yes. So that they were not able to liquidate to take care of the redemption pressure. So that is where we are staring at this particular problem.
Yes. All right. I think that more or less covers most of the questions that one would have in this situation. Of course, if you do have, and this is to our viewers, if you do have additional queries, you can send them to us. In fact, you can mail them to us on askpq@bloombergquint.com, and we'll take them to the experts. In the meanwhile, let me thank both the experts that have joined me today. Thank you so much, Suresh and Arvind, for joining us and for taking us through all of the answers that you did give us. Perhaps a little bit of clarity is needed at this point. And to all of you who have tuned into this broadcast, thank you so much for tuning in. And do watch this space for a lot more. We'll bring you more clarifications as and when we get them from the management of Franklin Templeton. Thanks so much for watching. This is BloombergQuint.